Welcome to the Real Estate and Wealth Podcast, your go-to resource for navigating the world of real estate investing and wealth creation. This podcast is brought to you by Calvert Home Mortgage Investment Corporation, your trusted, caring, and responsive short-term mortgage lender in Alberta and Ontario. We explore strategic and tactical solutions to elevate your real estate portfolio, drawing insights from seasoned Canadian investors and trusted advisors. In each episode, we dive into various aspects of real estate investing, including market trends, property analysis, financing strategies, risk management, and much more. Whether you're a seasoned real estate investor looking to expand your portfolio or a beginner taking those first steps, this podcast is for you.
Very excited for today's episode. We got the internal team, the rock star senior underwriters at Calvert Home Mortgage, Garrett, LaBarre, and Rob Maver, sharing all the insights of what they see on a day-to-day basis, their personal story, some really unique deals of what they've seen over the years, and essentially how we manage risk and how underwriting has changed through up markets, flat markets, and down markets. So I think it'd be really good just to start off, kind of overview of who you are, how you got into underwriting, and maybe some numbers of how many deals, if you have that, and dollar amount of what you've underwrote, either here at Calvert or just in general.
Yeah, I guess I'll start. My name's Rob Maver. I've been with Calvert for 6 years now. I guess my journey in underwriting goes back a few years, obviously, but when I was playing football, I was looking for the next opportunity. I knew that I had to get a real job eventually. Met the Kellers, met Jesse. Without getting too deep into that, there were some synergies between a project that I was working on with a friend and what Calvert does, and went on a business trip to Edmonton with none other than Jesse Bobrowski. And the first part of the day was me asking questions, just peppering him with probably too many questions. And then the ride back was me convincing him that he should hire me. And
I thought it was the other way around. I quickly found out, based on Rob's curiosity and alignment on passion to help others, thinking outside the box, that he would be a good fit for our company. So
yeah, so that was back in 2018, 2019. I was coming to the office after practice, and on the weekends I was kicking footballs, just kind of doing both, and then started full time at the end of the 2019 season. And then shortly after that was the 2020 COVID scare, where everybody thought that real estate was going to implode by 30% plus in values, and it turned out to be quite the opposite. So yeah, that's kind of how I got into underwriting. With respect to numbers, it's tough to say because, at first a good year individually was around 30 mil, but then that quickly went out the window when we expanded into Ontario during the COVID rise. I'd say on average, directly an associate and I have been responsible for around 130 million a year, give or take. That said, I focus less on the global number now and just kicking ass for our clients every damn day.
Love it.
So that's, does that answer the question?
That does answer the question.
Yeah,
so from kicking footballs in the CFL to underwriting.
From kicking footballs to kicking ass for clients.
Yeah, there we go.
The foot still moves. It's a big, wide, ugly thing underneath this boot, but it's still swinging. I still swing that thing in the house.
And for context, that dollar amount of deals we do, ballpark every mortgage we lend out is around $400,000, focusing on residential short-term lending. So 130 mil, 330 some odd clients served on an annual basis with Rob and his team.
Almost a deal a day.
Oh, it's bigger than that now, because that was 1-1. Now G and I each work with a team of around 5. Depending on the time of the year. So that number is about to get a lot bigger.
Yeah.
What about yourself, Garrett?
And my name's Garrett LaBarre. I've been with Calvert for about 6.5 years now. I had a bit of a different background, but it led to Jesse too, I guess.
All roads lead to Jesse.
Yes.
My story too. Yeah.
All roads lead to
Yeah.
Jesse.
I started in the mortgage industry probably about 13 years ago. I was with a different syndicated mortgage lender where Jesse was at the time. He called me into his office probably 2 months into my role there and said he's leaving, which I was pretty upset about. But I stuck it out there, learned a bunch about the mortgage business for about 5 years there, and then found out that Calvert was looking for an underwriter, and they'd be looking for a while. So Jesse and I connected and chatted over lunch, and started here, and it's been good ever since. So definitely seen both sides of the business, the syndicated side and the MIC, which we can discuss more if we want. But yeah, and then I'd have exact same sort of numbers as Rob for a team perspective, doing about 130 mil or so a year, and our group is now at, are we gonna hit this year?
442.
So we at least, well, this year so our year end is February 28th. So this is being taped on the first day of our new financial year. Everybody's got good vibes and things are rolling. We'll end out, give or take, 445 mil this past year. And we got our goals set on some really exciting numbers to serve 1,500 plus clients this year, 600 plus million of transactions. And thankfully to Rob and Garrett, we have the team that's focused on those unique solutions and client service that will get us there.
Mm-hmm. Yeah, and I think Rob mentioned it, but when we started, we were doing about 80 million a year approximately. So now to see us doing 440 million approximately, that's pretty impressive growth, and we're looking to do the same going forward. So,
and taking a step back, like what does an underwriter do for those who aren't 100% aware?
We make shit happen. It's the underwriter role at Calvert is really interesting because we have so many stakeholders with whom we engage. It can be other underwriters. It can be our funding team, our accounting team, our servicing team, lawyers, brokers, borrowers, our executives on, getting deals across the line. If I had to break down what we do, or state it succinctly rather, we are the client-facing decision maker of the company. We work with brokers. We work with borrowers. They bring us a file. Most of the time, it's a lot of information in a ball that's held together with duct tape, chicken wire, bit of spit, bit of gum. They throw it over the fence and say, okay, make something out of this. And it's our job to extract the information that's in the file, find a way to create an effortless experience for that client, and see if some of our unique lending solutions can help out that client. A big part of our job too is letting them know when we're not the best option. When Jesse kind of broke through our numbers there, if you're a bit of a math wizard, you might have been able to deduce that our approval ratio floats at around 25 or 20%. So we're saying no far more often than saying yes. So when we do that, how are we doing so in a way that lets them know what we could do and invite future business, but also connecting them with the people that perhaps could suit them best in their current situation, whether that be other lenders, or sometimes it's really tough calls too, like, hey, I think you got to sell your house, or these are the things that I would consider, consulting a trustee or a realtor and giving them that why.
Mm-hmm. Mm-hmm.
Yeah, it's going through all the docs, making sure we're underwriting the right risk, and also trying to think of new ways and solutions to try and help these clients. We don't want to think inside the box. We want to think outside the box and try and find the best way to assist these clients, whether it be through us or other lenders or whatnot. We've got a good database of people that we chat with, and make sure that we can try and help these clients in any way we can.
Mm-hmm. So I'm a real estate investor. Any tips on how I can get my deal approved, either at Calvert in general for lenders, like any best practices, or what you're specifically taking a look at from a client point of view?
I mean, we assist all our clients in any way possible. So obviously, the more information we have up front, the better. But at the same time, we're able to have those discussions. Rob and I, like Calvert's changed a lot. We used to be a part of the business development side, but now we have a whole BD team. But we are more than happy to meet with clients, work with them, just go through the numbers with them, try and find, like I said, the solutions that work for each scenario. But I don't know, every scenario is so different that it's tough to pinpoint exactly how to assist. It's more so just understanding that they are experienced real estate investors or not, and going from there and trying to help them out through the situation.
Mm-hmm. If the question is, how can real estate investors get their deals approved?
Yeah.
I mean, one, the answer is find good deals. That's the low hanging fruit in that response.
I mean, from an underwriting perspective, when we're underwriting flips or BRRRRs or those types of deals, the two main things we're looking at is, one, do they have the funds to be able to do this project? Two, is it profitable for them and does it make sense? So if you meet those two criteria, we're going to work through the rest of it with the clients to make sure we think it's a good deal for them.
Yeah.
And that's on the real estate investor side, which is at any given time 50 to 70% of our business.
Depends, yeah.
You guys also support mortgage brokers with short-term financing. Maybe a little bit about kind of what that looks like, what our best practices, and how do we do that piece of the business?
Yeah. So what's, in terms of, is working with brokers the most successful?
Yeah, like we hit on working with real estate investors and going back to their success is our success. And the best way to get deals done is have a profitable deal.
Right.
What are some best practices for our mortgage brokers who we support with short-term financing? And what does short-term financing even look like?
Yeah. Before we leave the investor, just a couple things came to mind. Be clear on your objective and what you're looking to achieve, because it's tough to work with somebody who says, well, I could do this, but I could do that, but I could also do this. Really
they're not clear on their path.
Understand what your goal is and what financial objective you're looking to achieve, because there can be a lot of different things in terms of leverage, in terms of profit, in terms of build your rental portfolio, in terms of getting somebody out of a situation and moving it to another family member. So understanding what you're trying to achieve and how that loan is going to be exited to, in addition to everything Garrett said. Going back to your segue, Jesse, on what short-term residential mortgage lending looks like, anything where there is a need for funds that can be repaid within a 6 to 12 month period. So transacting quickly. I need to close quickly because I went to the bank and they led me on, and my mortgage, what do they call them? Mortgage specialist at the bank went on vacation and now I can't get a hold of them. I got to close. It can be that. It can be, I need to pay my kids' tuition. I have equity in my house. I don't have money in my bank. It can be, I need to tidy up some debts and refinance. It can be, I need top up funds to complete my construction project. Quick close, the value's gone up from when I purchased it. I want to leverage that. There's a lot of different applications for our financing. We brought on a new member of our business development team, and she and I were chopping up our products, and she goes, these aren't mortgages, they're solutions. So if there's a need for capital that we deem reasonable, and if there's real estate to secure it to, with a plan to repay it by way of sale or refinance, we can do that. Like, one of the coolest deals that I've done recently was somebody bought a pre-construction property in like 2020. So the value is here. Value went up, value went down, but there's still significant equity that had accrued since the time the contract was written. Well, this person no longer needs the home because they've since filed a divorce. And the divorce settlement, she got the home. Didn't have any money, but they had a ton of deposits down on the property. She just wanted to sell it and get rid of it. So we wrote a loan where she went to the lawyer's office. She actually left with a draft because we were lending on the market value, not the purchase price. So she was able to help her kids out with some tuition, handle some of the leftover fees, and then sell the property. So that was, that's a different outside the box answer for what short-term residential lending can look like.
Yeah, that's a really good example. And that's a solution you know, a lot of times what mortgage brokers, the public, our shareholders will ask us is like, you guys are risky. Why wouldn't the clients just go to the bank?
Yeah.
And in that situation that you just mentioned, the bank would lend against what, 75% of purchase price?
Typically speaking, most A lenders, monolines, your cheapest capital, your A, they're lending on the lower of the two, market price or market value.
Okay.
So they're not getting, the client isn't going to get the benefit of the appreciation. So if you wrote the contract 5 years ago, why shouldn't you be able to lend on the market appreciation?
Right.
It's inflation adjusted plus the gains in the market. If you're a real estate investor and you're awesome at buying and finding deals, you're taking our risk off the table. Well, you're reducing our risk at the onset. So why shouldn't you be rewarded for your ability to buy well?
Right.
So, but most other lenders, it's, the lower of the two.
So in this example, we were able to provide a solution where we lent on market value, and because of the appreciation that client saw, they were able to put zero cash down, actually walk away with some cash.
Yep.
Give a short-term solution where they're going to immediately sell, pay us out, reap the benefit of that appreciation, and on to the next one.
Yeah. She still had to keep some deposit into the deal.
Yeah.
But she got her, most of her deposit back.
And we would call that an interim purchase to the market.
We would call that an interim purchase. Okay. And the takeaway there is lending on the market value, not the purchase price.
Yeah. That's a really good example of a short-term solution that would come through a broker typically.
Typically, this one came through a lawyer.
Okay.
But brokers can bring in that type of solution as well. And I'm seeing this more commonly this year, your agreement for sale, AKA rent to own, 3, 4, 5 year lease terms. And then they have an option to buy within that contract. So they're putting down a $20,000 deposit. And we've done a lot of those deals as well, too, where it's somebody who's been in the property for a long period of time. We confirm that the rent is current with the landlord. Obviously, the contract wouldn't be enforceable if not, but I'm seeing more of those scenarios come up too, where at the onset, the value was lower. Now it's greater. They get to keep the property that they've been renting for a few years and get some equity in their net worth statement at the same time.
And I'd assume another big value add is the fact that we're doing fully open mortgages.
Yes.
That they could pay off at any time. So her plan was to sell almost immediately after taking possession. So set it up fully open, pay it off at any time, whereas other lenders might offer you to close the mortgage and you got to take into account that payout penalty.
The early payout penalty,
which can be significant. The IRD or 3 months interest, that can be significant depending on the size of the mortgage and
like
the cost of capital.
If you're borrowing $400,000 again, our average purchase price, today a mortgage for that would be a couple grand a month in interest.
Yeah.
So 3 month early payment penalty all of a sudden is $6,000, and you might be getting your rate at 3.99, but that's a big hit to your profitability.
Yep.
That's a good story. Garrett, you got any cool stories of a recent? Maybe we'll do a real estate investor transaction or a typical real estate investor transaction, just so we can ground kind of what we do on the short term mortgages with real estate investors.
You know what? I don't. The one that comes to mind is in real estate investor transaction. It's one that I did a while ago, but it was so unique that I think it's worth sharing.
Yeah.
It was a couple who was wanting to buy this property, and they had a commitment from the banks set up, ready to go, but the banks couldn't close it in time. So it was like the purchase was on, let's say, March 20th, and the bank could commit to doing it on March 21st.
And
literally the day after.
And what would reasons be why the bank can't fund in time?
Just appraisal maybe taking too long, or they had certain conditions that they couldn't meet in time. Funding internally took too long or something like that.
Okay.
But anyways, we received this.
So they needed it. They have an offer to purchase, but the bank can't do it until the next day.
Yeah. Seller said, no, need you to close on it. Like, we got to close on another property.
Yeah, an agreement's an agreement.
You gotta close on this thing. So we received it, I think, 2 days before it needed to fund. And we were able to do it really quickly in our bridge financing model, where we're charging a 1% fee or maybe a little lower depending on how big the mortgage amount was. And so we funded it, and Scotiabank or whichever bank took us out the next day. It was 1 day.
Oh,
One
and
day.
and this is a mortgage where they were planning to live in long term.
Yeah.
Okay.
Term. So the banks were happy to take us out. It was a low loan to value. They were putting like 30-40% down. And they took us out the next day, which was unbelievable. I was like, banks really couldn't just push it 1 day more. Like, just sometimes there's those scenarios that it just doesn't quite fit. And we take those over, and it's obviously a really good mortgage for us to do and assist them with it. Obviously, we'd love for the clients to be able to line those dates up and just take the long-term mortgage because there's an added cost to it. But we provide a solution, and the clients were super happy to get in the house, not lose the deposit, and then get with the banks the next day for long-term.
Amazing. On the flip side of all of this, what's been the most challenging file that you guys have worked on?
Or files.
And why?
Yeah,
Files.
that's a really good question. Like these,
Like when we funded?
these guys are in charge of managing risk, and our business is managing risk.
Yeah,
Managing
We're gonna see
clients' files. What's been
Over
a
the-
challenge?
I mean, how many of our shareholders are watching this? Because I have a couple doozies that I
mean-
can talk about.
I mean, we're underwriting risk, and we understand it's high risk, so we're gonna take losses at times, and that's just part of the game.
Mm-hmm.
Yeah.
Oh, no risk it, no biscuit.
Losses low.
Yeah, but to the losses point,
Yeah.
before we get into, because Rob made an excellent question on transparency and sharing with not only the mortgage and REI world, but our shareholders. So we absolutely manage risk, and part of that is to take on sufficient risk. Garrett has a unique position in the firm where he also works with our shareholders to engage them and make sure that we have the capital. Garrett, what do our loan losses look like? Talk in generalities, because we're not allowed to talk specifics. But in generalities, like, what do loan losses look like for us?
Well, right now I was just talking to our arrears manager last week, and he said right now we're sitting at our lowest in a very long time for what we're expected to lose at about, he said about 800,000 is what we have set for reserve for losses.
Right, on a fund of over 300 mil. So quite
So
low.
it's pretty low, and then our historical loss ratio is around 0.32. So we take on risk, but we also mitigate that risk by all the good deals that we do, and we.
Historical performance has no indication of future.
Future performance.
That's right. Good disclosure. But do you want me to talk about a deal that was?
I want to hear the dirty because everyone always explains the deals that go well.
Dirty, and I think how we work with them and
Yeah.
like the lift that you guys do to manage risk.
We actually, there's a file that comes to mind that we actually didn't take a loss on. The client unfortunately did. And the main story about it was just a real estate investor that didn't do a good enough job of doing an inspection of the property. So when taking it over and doing some renovations to the property, he found a crack in the foundation. And he wanted to refinance it. And the banks wouldn't refinance it with that defective property. So he needed to spend a significant amount of money to rectify that, and took a loss because of it. Calvert didn't lose any money on the deal, but obviously it's the real estate investors are ones we want to keep, and they're ones that we want to see make profit on every deal so that we continue to build business with them. So it was tough to see, and it was just one of those things that, hey, if you had even a contractor go through a little more in depth into the property and see what's there, like, we always ask the questions about, hey, have you checked out the property?
Yeah.
You make sure that there's no large defects and different things, such as like issues in the mechanical room, or foundation's a big one.
Attic.
Roofs can be expensive, attic, that sort of stuff. Any leaks, like, all these they can all be fixed, but how much does that cost? And have you taken that into?
It's going to eat into your profit. So what ended up happening with that file and that client?
So he was able to fix the problem to the foundation, and I think he refinanced. He might have sold it, but got out of the deal obviously at a loss because we weren't expecting that cost. And it was just a learning. And I think we've done deals with him again. So obviously, I know he was an experienced real estate investor, so he knew he's going to take some losses. Like real estate investors, they always look at it as a whole. Like
Portfolio management rather than single
I
deal.
have 3 deals, and I made profit on 2, lost on 1, and my net is still above where it should be. So, I think he's still doing deals and learn from that lesson. Just pay closer attention to the property in the future. So.
What about yourself, Rob? Most challenging deal or one that comes to memory?
I got 2 that I want to talk about. Disclaimer for mine. Remember what Garrett said about our loss provisions and that they are currently historically low, because I don't want to scare some people. You know, one that I recently had, the property was supposed to sell, and the property inspector said, "Oh, I didn't know that there was a pool in the house." I said, "What do you mean?" And there was water coming out of the basement windows. So that property was intentionally flooded.
Coming into the property?
Outside. Bathtub plugged. Water was coming outside.
Oh my gosh.
So that was one. But I think what I want to do is take a deeper dive on a property that that made me lose my hair.
So hold on. Let's double click on this intentionally flooded. Why?
I don't want to speculate as to the why, but this was a client with whom we had done a lot of business, and things were going very well for a long time until they weren't. And it was past the point of no return, and that they'd bitten off more than they could chew. And I suspect this might have been their way of emphatically ending the relationship between borrower and lender.
Okay, not cool. But what?
Very not cool.
Okay, now let's take us all the way through to the end result. What do we do? Insurance
claim.
Okay.
With this is why insurance premiums always go up; they never go down.
Yeah.
but thank goodness for that.
And did the client sell the property? Who sold? Did we end up having to take over that?
Yeah, we had to take over the property. In Ontario, you have different enforcement remedies, obviously power of sale or foreclosure. One, you don't take title, so you don't assume the same liability.
Which is power of sale, correct?
Which is power of sale. You just basically step into the shoes of seller, but not property owner, if I had to state it succinctly, which absolves you of a lot of liability that an ordinary seller might have. So we had the duty of remediating it, which insurance claims offset. But you see some crazy stuff. I think one of the more challenging files that I've done recently, it was a flip in southwestern Ontario. I'm not going to name any city names or street names or anything too descript, because somebody might be able to piece this one together. Client, repeat client. This was his second file with us, and they had sick family. They had to go overseas, look after their family.
Life event.
Which
typically the life events are where we see arrears and losses. There's typically an underlying life event where they lost focus, lost their ability to execute on the plan. Is that correct?
Yeah, I've had flips where regrettably I've lost money, but the borrower died in the property. You can't do certain things about that. There's borrower error, there's underwriting error, there's life event. So this one has many of those.
Okay.
So let's get into it. So repeat client took possession of the property, got the property gutted, life event, had to go across the pond to look after some family. Payment started to bounce. Okay, this isn't good. This was a low down flip that was gutted, so not marketable. I'm definitely over 100% loan to value at this point. The property of its current state. Business partner steps in.
So what are you doing while this is going on? as the underwriter, you have this sense that, okay, property's not being executed on.
Yeah.
How do we manage that?
So one, I lost hair. Kidding. But actually, our stressed minds don't think clearly.
Yes.
As somebody once told me in a blue suit opposite me right now. So then I thought, okay, what needs to happen? I had a very motivated party in that it was a business associate of this individual who was no longer in North America. Great. Rob, I don't have any money, but I have credit cards and a line of credit. I'm going to complete the project. Great. I had him send me bank statements. I had him send me statements. And of course, signed an agreement with him. So we were able to engage with this individual in this manner. We're checking off all those proper boxes there. But basically what I did is I horse traded for progress pictures to confirm that we had a marketable asset sooner, or we would have a marketable asset sooner than later, in lieu of payments. I was more concerned about the asset which we were secured to rather than collecting the monthly payments, because that's ultimately what's going to see our property or our mortgage repaid in full with sale of the property.
Right.
So this was a painful process that lasted upwards of 6 months. So we were accruing interest at a high rate that said I valued the after repaired value greater than the myopic lens of just looking at collecting today.
From a business case, complete the asset,
right,
and mitigate losses. Ideally, maybe there might be profit in there. And your decision was, I'm going to work with them to manage them through this, and while accruing payments rather than forcing more for somebody who doesn't have free cash flow.
Yep.
Rather than forcing free cash flow to go to payments, you're forcing free cash flow to go to the project.
Correct. Collect the whole bag later rather than smaller bags now.
Yep.
While also engaging with that individual who's overseas. Great. So we get the property complete. Okay. Then I learned about the Municipal Planning Act in Ontario, whereby if you have two abutting lots, they effectively become one, and it invalidates all mortgage or all encumbrances on title. And the nuances of this are going to vary by municipality. But in that instance, they had the property sold and there were issues with that buyer. And as we got closer to closing, we realized, wait a second, we have invalidated titles. We cannot transact. So then it became a matter of, okay, and interest is still racking up at this point in time.
Right.
So the loan to value is getting higher, but at least we have that. Okay, fine. Go to the municipality, get that dealt with. I'm trying to think what happened next.
And so you got a lawyer now trying to transact. You got a seller trying to transact. You got a lender. Everybody's interests are in getting this thing transacted. Who's leading this?
I was with them, and I think I wanted it more than them at the time. The lot that was abutting, which he did not disclose on his mortgage application, was also being enforced on by Equitable Bank. So there was some interesting dialogue between them and their lawyer.
Because now our titles have merged essentially.
Yes.
And we're with this other financial institution.
Yes.
Okay.
So basically, a lot of things happened. This went on over several weeks. It became clear to me that we could no longer rely on the person to perform, but at least we had a completed property at this point in time. Great. I said, and I should have done this sooner. I've invested enough of my time and the company's time into this file. Put this in the hands of the enforcement lawyer. They were able to get the Planning Act. They were able to get the mortgage revalidated. That was a whole contractual.
So they managed through it with our lawyer managed through it with the municipality and the other bank.
And Equitable's representation,
right,
who was also known to us. So it was very interesting. So long story short, after trying to work with them and trying to make it all happen and directions and this and that, okay, done. Put it in the enforcement lawyer's hands. They got the titles remedied. The mortgages were declared valid by the municipality. We now have the property on the MLS to sell. Great. We get the property sold at an amount that's going to pay out the mortgage in full. Great. The morning of closing, our house mysteriously lights on fire.
Oh my gosh.
So that's why I don't have hair. But that's one of the most interesting files that I think I've done from an enforcement standpoint. It was the calculation of, do I collect payments or how can I work with them on making sure that we can get a property that's eventually complete? How do you work with a borrower that's really not motivated or caring about this anymore, and then engaging a new business partner to complete? Later learning that they didn't disclose things on their mortgage application, and they were also under further legal trouble, managing the Planning Act, managing lawyers, managing municipal planning departments, a new enforcement lawyer, and then a property that was charred. So that one gave me a bit of everything. But you shouldn't pay for expensive tuition if you're not going to learn from it. And I definitely learned a lot from that file, including the benefit of insurance.
That is quite the
Thanks for that
story.
And I think that's a really good one. You know, our business is relatively simple, where we are a mortgage lender lending against residential real estate. And those transactions from a high level are simple, but it is extremely nuanced. And to be able to properly underwrite and manage risk is no joke. So to the listeners out there, you know, a lot of companies where Garrett and I came from on the syndicated side, a lot of people will lend out money individually. A lot of people will lend out money through third parties who set up the transactions on a one-on-one. And it is important to know the risks, to understand how to underwrite, to understand real estate.
Yep.
And while it sounds simple, these examples are really important to understand how nuanced it can be, how important insurance could be, how important processes, how important understanding real estate and the law surrounding it is. It's no joke.
No.
And by not having that level of sophistication, you're really putting yourself at risk.
It's hyper specific in terms of the municipality that you can be in, and the enforcement process. Now we have an individual who looks after it primarily. Until recently, Garrett and I looked after a lot of our own stuff in that regard. And
yeah, we would underwrite cradle to grave, which we meant, you know, we'd underwrite it from inception of the loan all the way through payout. And in the rare instances where they do go into enforcement, the underwriters used to fully manage that up until about a year ago, I would say.
yeah, and it's a dynamic process, Jesse. As you know, it's at the banks most of the time. You have, you know, your 20% down mortgage on a marketable property, unless it gets trashed by a tenant or the homeowner. There's really not much to manage, and a lot of that gets contracted out to a property manager who looks after it past that point. It's keep the heat on, turn the water off, lock it up, boom, court sale, done.
Secure the property.
Secure the property. You don't have to worry about those things. But in the instance when we specialize on working with real estate investors, depending on when you take over that property is really going to impact, okay, where am I at today? Where could I be? What is the cost benefit of doing this?
Yeah, even thinking through it where you made a decision that we are going to work with the client to get it to completion because that's in everybody's best interest to manage risk.
Yeah.
That those considerations aren't always taken at different levels of financial institutions.
Yeah, it's not even perhaps known.
Right.
You know, they're only really recording their loan to value at origination. They're not following the bouncing ball, i.e. market trends and current condition. You know, and there's a lot more of those stories where that came from, but you know, the basement swimming pool and the mysterious fire on the morning of closing are the ones that have perhaps taught me the most.
Jeez. What's been the fastest deal either of you guys have ever closed, from client submits a deal to you to funds out the door?
That's a great question. We're known for fast funding. Tell us how fast we can be.
I mean, it varies based on a couple things. One, we still do some in-house closings, meaning that we don't have a lawyer acting as part of the deal. We're able to sign with clients internally if we're just adding a mortgage to the title. In those cases, I've funded deals. I can't give any specific examples, but I know I've funded one where I received it the morning of and funded in the afternoon.
Cash in the client's hand in the afternoon.
Yeah. So that's the in-house side.
Mm-hmm.
I'd say on the lawyer side, we funded deals in Alberta as quickly as one day. No doubt about it.
So you'll get the applicant.
Like it's from getting all the information that we need to funding. So saying like, we'll get some detailed packages sometimes either from a client or a broker. And if I receive it this morning, saying they need to close tomorrow afternoon, we can do that in Alberta. Ontario is a little more tricky because we have to use 2 lawyers as part of the funding process, whereas in Alberta we just use one, which saves the clients money. And,
Which is the borrower's lawyer we use in Alberta.
yeah. And Ontario, though, we can do it in 2 days. It really depends on the lawyer in that instance. Like once we get all the information, we get instructions out the door. A lot of our work is done, and it just depends on how quickly they can get all their conditions met.
So you've seen instances same day funding when it's in-house where the client owns the property. We're not moving title. We're just registering a mortgage to an existing title. And next day, no problem for us in Alberta.
Yeah, those would typically be just an equity takeout mortgage or a debt consolidation or
Stuff like
one of those where we're adding something to title. Yeah.
Rob, to lead into that, do you have any cool, unique stories of where we turned a file around at the speed of business?
Canada Day miracle for Josh Shigelki.
All right.
A few years ago. That was when I was trying to prove myself in this business. File came over the holiday.
Josh and I were tilting back some beers at Maple Lake.
Rob was having a beer and replaced that with a soda and a coffee, and went back to his desk to create some happy client shareholder value. I remember everything about this property, the borrower name, the address. I underwrote it after hours, did the value myself, and we got it funded within 4 business hours the next business day.
Yeah, because the deal fell
over a
apart
weekend.
on Canada Day.
Yeah, it's the business day prior, and awesome broker, really interesting client story. Threw a Hail Mary at us, and yeah, it was did the work after hours, confirmed with our valuator the work that had been done. Teed it all up so admin could get going on it, and then within a few 2 hours of being at the office, I had a check in hand and I was driving to the lawyer's office, and we can make things happen. We also like to look at deals that maybe don't need to be funded in 4 hours, but we can move as quickly as we can.
Things happen.
Things happen, and we can move really quickly to make things happen when maybe other people can't. And the thing that affords us the opportunity to do that is we're given, the information, work hard to do so, because underwriting deals, when we have really good internal guidelines, we have a wicked team. The X's and O's of underwriting, when you get it, are pretty simple, dare I say. It's how do you work with people to make things happen in the timelines that happen. So it's not just getting the decision or getting the information or having the information in front of you, making the decision. It's how do I engage the client in a way that they provide the information that we have, or how can we work with what they have? Or are we calling a lawyer and making sure that they have capacity to take it on under time constraints? And are we running over to accounting and saying, hey, I need a draft or I need a wire at this time? So it's not just looking at something and pressing a button that says approve. It's working with the applicant, working with the broker, working with the lawyer, working with the drive-by company, going over and talking to our funders, making sure accounting can get the money out, signed up. If our executives are out and about, okay, we need to get this check signed. Do we have enough check signers in here? So underwriters really quarterback the deal.
Mm-hmm.
They grab that deal, they wrap their arms around it, and they say, we're going to get this borrower a set of keys. And how do we get everybody pulling in the same direction to get those keys released?
Yeah. And just so we got some context around this Canada Day miracle, why did the deal fall apart? What was our solution, and how we always talk about the exit? How did the client get rid of us?
So the reason for this deal falling apart, they didn't like the source of down payment.
The bank
didn't like the source of down payment, and they rejected it at the 11th hour after the file had been instructed.
And what if you can remember, what would an example of source of down payment that the banks won't like?
So in this instance, again, I'm going back almost 5 years now. It was funds that were held funds that were held by a trustee for their benefit, and it was like sale of family property that had been assigned to them.
Parents were helping them.
Yeah, parents were helping them, but it wasn't that clean. Like
Okay.
that's a quick version of it. Typically banks are going to want to see bank statements or, really clear linkage of, this is Jesse's money because Jesse sold the property. Here's a sale contract. Here's a statement of disbursements from Jesse as a seller. Lawyers paying Jesse. That's good kind of thing.
Right. Whereas when it comes to a family trust and
it's not linear.
yeah,
It's not always linear. And we have the ability to take what most lenders would want as a clean line and maybe something that does this. And as long as we can figure it out, we'll make chicken salad out of chicken shit. Just, it needs to be good enough.
So we come in, we are comfortable with the down payment, fund it, and then what does the client do after that?
Client's very happy. 1, 2. In this instance, they did some light renovations to the property and sold it.
Okay.
This was a duplex in Bankview, actually, so I got to do the drive-by myself because I lived nearby at that time. Still do. But yeah, I know exactly where the property is, and they got it fixed up and they sold it. And we still talk to them. I'll still follow up with her occasionally to see what's going on, if she's got any other flips or whatnot.
Amazing.
But
Were they profitable?
yes, they were. Yeah, this was the golden heyday of flipping. This back in 2020, people were doing really well that summer in Ontario. Garrett and I would joke, wipe the counter, the Lysol flip, where you take possession, you take one Lysol wipe, you wipe the counter, maybe you change the locks, you put 70 grand in your pocket and you sell the property in 2 weeks. Reverse order those last two things. But yeah, it was the best of times.
That's when I started. It was, absolutely wild.
Yeah.
I mean, let's touch on that a bit.
Yeah.
I think a lot of our real estate investors are realizing that they don't have to do the massive renovations anymore. Obviously, it's going to depend on the neighborhood, but a lot are choosing just finding good deals and doing maybe a $30,000-$40,000 reno and making sure that it's livable, and maybe doing more projects. That's probably one of the more challenging things as an underwriter at Calvert, is that you really like to work with real estate investors that do multiple projects at once, but we need to make sure that they have enough capital to be able to do that. But they can maximize profits by doing multiple projects instead of just putting all their cash into one deal. So if they can do 3 flips at once or 3 properties and renovate them and either refinance or sell them, they can see that profitability annualized increase like crazy if they do 3 instead of 1.
Versus one big one with a massive budget.
It's just on our end making sure the capital's there to be able to do all those, and while taking into account any contingencies or different things that could occur. It might take a little longer to complete. But yeah, a lot of our real estate investors are starting to do those $30,000-$40,000 renos, finding a good property and just getting it back on the market quickly. So I've kind of seen that shift lately. I don't know if you're the same, but yeah, just operating with even more speed than they were before. Because right now we're in a more of a balanced market, so it's a little more challenging to get those uplifts that we saw when the market just kept increasing. So time is obviously one of the most important things when it comes to real estate investing.
And I guess when they're doing those light renos, they can move them quicker, and there'd be relatively less project management.
Yeah,
right. Like it's more clean of a process.
Yeah, and they're usually in neighborhoods that are, let's say, in the ARV finished product at 500,000 ARV as if renovated.
And for Calgary, that
so
would
like
be
northeast,
the lower end of the price.
500,000 to 700,000, which those properties are still transacting.
There's so much demand at that lower end of the market.
So that's what people have realized, just sticking with the market, understanding the products that are moving. And I think that's a change I've seen recently. More people.
And does your guys' underwriting change versus seller's market or buyer's market?
I mean, we certainly take into account economic conditions and how things are. But we're still valuing the property. It's a tricky scenario for our valuators, right? The more information they can get, the better. and they watch the HPI data, understand where the market is going, but they're valuing it today as if renovated for a day down the line. But we don't know where the market's going to go in 3 or 4 months. So we're valuing it as of today. That's what people should do. They shouldn't take into account when people tell us, "Oh, the spring market's going to be better. It's going to be better." You can't guarantee that type of stuff.
Mm-hmm.
So just valuing it as of today, as if renovated, understanding if there's a profit there. If there's a profit there, our underwriting doesn't really change. It's still a good deal, something they should buy and proceed with.
Mm-hmm. So someone comes to you, they're banking in appreciation because of the spring market. Like, what does that conversation look like to the client from an underwriter's point of view?
Oh, I just blame the sales data. I love speculators because, speculation, you're banking on something that doesn't yet exist, basically. We need speculators. They play a valuable role. Without them, pre-solds don't break dirt, and they move a lot of deals. So I love speculators. Keep coming. But in that case, I just create a common challenge, and that's the sales data that we have to work with today. Mm-hmm. And at the end of the day, if, is there a way to still make the deal work? So it's not, hey, this is what we're seeing, and, we think you're this because you're banking on something that doesn't yet exist. It's, let's talk about that and get a sense for where we're at today. Why are we at where we are today? And what are some leading indicators that typically have a correlation with future values? So labor, retail consumption. With us, the easiest one is inventory, because that's a leading supply on what, or a leading indicator for what valuation could be down the road. Are you looking in an area where there's low inventory, like say Bonavista in Calgary? There's certain communities that don't really see a ton of price movement because they're continually desirable. Or are we looking out in the burbs? Downward price movement, sorry. Or are we looking out in an area where there's tons of stuff available and it's more sensitive to price movement due to, seasonality or inventory? So it's really just inviting the information that we have, showing them what we have, inviting what they have, and having a discussion, putting that out in front of both of you and having a discussion about that rather than what you each believe. Because that can be pretty tricky sometimes, it's hard for investors to find deals. And when they find a deal, they're excited, they're fired up. They become emotional. I shouldn't say they become, but it can become an emotional, buying journey. And it's really important to just step back from that and say, hey, let's just look at the information that we have together.
Yep.
And attack that together if you have to. And if there's a way to make it work, putting more down, adding other property, maybe inviting new information that we haven't considered, great. But it's a tricky line because finding deals is tough, and we want to do everything that we can, not just to prove the good deals, but also if we're helping somebody not do a deal that we don't believe in, they need to understand why. Mm-hmm. Otherwise they're not going to come back. So those calls take time, and it's great because typically speaking, you're creating what's hopefully a lifetime client.
Yeah, we're always happy to be challenged too. So the conversations, yes, they can be challenging, but just having the conversation and talking through it, maybe inviting more info, like Rob said, can help us get the deal done. But ultimately, like Rob said, we look at the value today, and if it's profitable, okay, and you think it's going to be a better market in the spring, okay, great. Might make more. But if it's profitable and the market goes down, okay, we still thought it was profitable then maybe it's just a little less or no profit, and you move on to the next one. And it's a tricky cycle, but speculation's not something we take into account when we're valuing and doing the underwriting. But I mean, if you can have a profit as of today and the market goes up, that's an added bonus.
Mm-hmm.
Right. So just to summarize that, we as a company do not speculate, and you guys as risk managers and relationship managers from time to time have to work with clients who are trying to bake in appreciation, and then you manage that delta between here's what we know market value to be, you're going to be successful regardless of some movement up or down, and we take that risk on. Great that they have a thesis that it's going to appreciate, but that doesn't come into our underwriting, yet it does come into the necessity for our underwriters to manage that relationship and let's call it that delta in thinking.
Yeah.
specifically, are you able to give examples of what data you would be sharing with that client if you're not aligning on what you think the property will sell for? Because I know it happens, especially.
Yeah, what I like to do a lot is just provide them with the comparables that we used.
Yeah.
So sending them, hey, this is what we took. I think, and then we send the HPI data where the market's trending in that certain area. But I think the biggest discrepancy and I'll say issue that we have sometimes with what's submitted is the renovation details.
Yeah.
Right.
So like you got to think of how challenging it would be for an appraiser, in our case, valuators, to do a value based on what it looks like and then giving us reno details. And if you're only saying, I'm going to do kitchen, I'm going to do bathroom, I'm going to do this, it's like, okay, what?
Yeah.
And it's not a random number.
We're doing that, but like, what are you putting? What type of flooring? What type of countertops? What are you doing in the bathroom? Like, how's it going to look? Even providing us like previous examples of work that they've done in the past, and they say, okay, it's going to look very similar to these upgrades.
Mm-hmm.
But I think that's the biggest challenge when it comes to why we might have a different idea of what the number is going to be than they do.
Right.
So if they provide as much detail up front, that makes our evaluator's job easier, and then we are more aligned on where we think that. But I provide them with the comps, provide them with the HPI data, and they can come back to us and say, hey, this one just sold here, and I think it's a pretty comparable property. And they can say, okay, can you look at this and see if that changes your opinion?
So you'll work with the clients and the data to make sure that we're taking everything into consideration and educating them as well. So you're educating the evaluator, yourselves, and the client through that process.
The market should know that we have all the internal data and information on TREB and all the other areas in Ontario and Alberta. So we do have access to all the sale data and whatnot. So usually we're going to know all the best comps, but sometimes we'll miss something.
Yeah.
We definitely invite the information. Like if they think it's different, we're going to work with them, see if we miss something and try to make the deal work if it's worthwhile.
Makes sense. I know we're pretty much at time right now. Anything?
I got two more questions.
Okay.
Two more questions for the boys.
Yeah.
So when you think of what a mortgage underwriter does what a typical mortgage underwriter does versus our approach and what we do at Calvert, let's just, so the listeners, brokers, REI shareholders can understand, you've talked about a ton of work that you guys do. You've talked about the solution that you guys create. How would you summarize the difference in Calvert underwriting versus what typically an underwriter would do? We'll go Rob, then Garrett. Rob's chomping at the bit.
Yeah, no, this is I'm pretty passionate about what we do, and that I'm grateful for our competition, as bad as that sounds, and I'm happy to put what we do up against anybody else. The majority of the underwriting in the industry that I observe is primarily formula driven, and that you send in documents, I'm not going to go get them, but when you look at it, or when you send it in, I'm going to look at it and see if it fits certain boxes. And maybe I'm not really thinking about it too hard. A lot of my work could be adjudicated by AI, and maybe I have to look at a few documents, but primarily I'm checking to see if a square peg fits in a round hole, or in a square hole, pardon me. And maybe I'll get back to you when it's convenient.
And this is what how the industry does it typically.
Yeah, and obviously there's, that's oversimplifying it or perhaps being a little bit cynical, but it's, does this fit in this hole? And I'm not gonna go too far outside that scope.
A process of yes, no questions, and don't deviate.
And send me what you have, or this is exactly what I need, and I'm gonna let you know if it fits my checkbox. And okay, it's a rush scenario, I'll get back to you, great. But that's typically it, oversimplified. Whereas what we do is we put ourselves in the client's shoes, we link arms with them, we grab a sword, we grab a shield. The objective is slaying that deal ahead of us. If the broker's having a tough time engaging the client, we're going to engage the client. I've done things like text people, call people after hours. If it's a file that needs condo documents, I will call the property manager if the realtor isn't getting me the documents. If I have permission, I will work directly with the client's lawyer to let them know of the time constraints. The realtor, and that I need to see a certain amendment, or that I need to see something, or if there was a mistake in the contract, we do whatever the hell it takes to make the deal happen, and inform people of the why every step of the way.
Mm-hmm.
And we're motivated by the outcomes. It's really exciting when you can help a client. Like one of the first deals when I first got my own underwriting authority here was a guy that turned $250,000 from a burr back in his pocket in 11 weeks. How cool is that? He's never going to forget that deal.
Mm-hmm.
What would I have done if I had $250,000 in my pocket, 6 years ago from a burr? How impactful would that be for me? So we're really motivated by the client's success, and we take ownership of the deal ahead of us, and that whatever needs to be done from a deal perspective or a stakeholder management perspective, we execute.
Mm-hmm. Good summary.
Very well
Very
put.
good summary.
No, I like it. I think overall, just summarizing, like very solutions based, thinking outside the box, trying to get deals done. The only thing I'd really add is what I talked about before. Like underwriting was business development. And I still think we are.
Absolutely.
Yeah.
Like a bunch of our underwriters are at industry events. They're taking people out for lunch, coffee,
Mm-hmm.
just getting to know them, understanding our clients, really relationship based. So I think that's a huge difference when it comes to underwriters at our office and some others. I'm sure there are others that do the same, but I think our underwriters take pride in that, being very relationship focused. And we work a lot with BD, with Ryan's team, and making sure that we're reaching out to people, letting them know all the updates and what we're doing and how we can do better, searching out feedback. We're very aligned on that, and our teams are aligned to make sure that we're doing everything we can to assist our clients in the best way and making changes when we need to.
Amazing. So let me just summarize that piece, and then my last question.
Yeah.
So I'll call it the Calvert difference from an underwriter perspective is client focused. You are experts in both managing risk and providing those make sense solutions for the client. It goes back to understanding the client's needs and the deal's leads so that you're setting these clients up for success, and leveraging a ton of variability as it relates to the options that we can provide. So it's not just checkbox underwriting, so to speak.
Yep.
Amazing. Okay, last question.
Yeah.
Time for one more question.
You betcha.
Okay. So, and I'm going to go around the horn here. I'm going to include Ryan in this question. So, thinking about where Calvert Home Mortgage is at today and where we're going, what are the one or two things that excites you most about our business and the industry that we're in and the solutions we provide? So like one or two things that excite you most about the future.
I would say, one, growth is always exciting. So preface my response with that. Understanding more situations that our solutions could be applied to. So when I talked about, that pre-construction purchase, separation, left the lawyer's office with the draft to pay some tuition, cover some legal fees, and not have to worry about that situation. That wasn't something that I would have immediately thought of previously before that file. Obviously helping real estate investors make money and helping people make money, but just understanding more problems that our mortgages can fix. That's the really cool piece, or finding different applications and ways of underwriting those applications. So if it's creating a new internal tool to help people work through deals, or understanding a problem that the market has, how can we solve those problems? Those are the things that excite me about where we're going, in addition to growing our balance sheet.
Just came out with one. Talk about that one.
The land one?
Yeah.
Yeah. So I guess that kind of segues into this. The land piece. one of the things that
Right. Like we're always trying to, I love Rob's answer because we're entrepreneurial and always trying to think of ways that within our risk standards can apply to different situations. So entrepreneurial mindset, finding innovative ways to help. That basically is what you're fired up about.
Yes.
Okay.
Yes. And, Garrett talked about, we work with real estate investors. Jesse said on any given quarter, it's 50 to 70% of our business. We're seeing a big trend towards people going towards increasing density in urban centers. And one of the ways that they're doing that is they're finding homes that have little to no remaining economic life, in layman's term, depreciated house. And they're closing on the land and they're rebuilding. Sometimes they will also look at taking that lot and turning it into 2 or 3 lots, depending on what the zoning permits. And we have just developed a new product where we can work with people on closing on the land value or with the value of that house, depending on what their plan is. But what perhaps is the most innovative is that we can consider the as subdivided value. And basically, if we have a big lot, we can value it as 2 or 3 lots. And generally, the sum of multiple lots is going to be more valuable than the existing piece. And that can allow us to offer higher leverage, aka lesser down at closing. So we're in touch with what our clients' needs are, and we're trying to develop products for them. To that end, too, if we're missing on something, let us know because we want to find a solution for it.
So that's a solution where we're providing short-term financing.
Yes.
For people that are planning to build a property.
Potentially, yeah.
We lend on the value of that land,
Yes.
whether it's as is or with a plan in mind.
Yes.
They execute, get permits, drawings, budget in order, and then they're exiting us through construction financing.
Yeah, I mean, everybody says CMHC because that's the sexy play right now. But there's a lot of other different types of lenders who do this. Credit unions. There's other.
The banks are paying attention to it. To your point, the municipalities are reducing ways to build density, and this is one way to do it by allowing for higher density on a current single-family lot. So as the trends go, we try to find solutions, as do the mortgage market as a whole.
I'll say we always had this product. Like, this was always a product of ours, but we made it official with a new product sheet. And we noticed a need in the market, so we really wanted to make something official, put it out there to the market. And if people are looking at short-term financing for lots or just a house or just anything they want to purchase and build on eventually, reach out to Ryan and his team, and they'll get you the information on this product.
And in Alberta and Ontario.
Yeah.
Yeah. What loan to value are you, and how would you underwrite one that's being torn down versus one that's not being torn down? If there's
so if they're keeping the property on while our mortgage is in place, we can go up to 75% loan to value.
Okay.
If they have plans to tear down the house right away, we can do 65% loan to value.
And if they're selling the land
on the land value. Okay.
Yeah. We will do the value internally, as always, at no cost, and do it based on what their plan is.
Yeah.
And when they're planning to subdivide, what do we do?
We'd value it as if whatever their plan is.
Okay.
I subdivided then.
So if there's going to be 2 or 3 or 4 lots, and they can execute, we'll value it as if those lots are subdivided.
Correct.
And go up to,
well, in that instance, 65%
of the final value.
Correct. They got to have some skin in the deal, but that can be achieved in many ways. It's not just down; it's blanket mortgages too.
So to that point, we're also really blessed that we have underwriters that are true experts, and the way that this use case got built out was Rob, Garrett, and their team said, "Hey, we're seeing this. We know our product fits, but let's get really specific on how we would attack this solution." So they bubble that up. Work with BD and portfolio management to get really clear. Yes, we can do this, and then we can go. We now go to market with this specific use case under our short-term lending strategy.
Because we know we're probably not the best to provide construction financing or any of that. So we just knew that people needed to close on these lots. don't have enough time, because to underwrite those construction and multifamily deals takes a really long time. So people need that short-term financing to at least buy these lots and then work with another lender to be able to get the construction financing.
Even like permits and
it's a lot of work.
It's a lot of work. So we enable them to close on what our borrowers and we believe is a really good purchase, and then get their ducks in a row. We're long-winded here. Okay, Garrett, what are your one or two things that you're most looking forward to in the future?
You know what? I think Calvert's at a really good point right now, just for the company as a whole. And I think what excites me the most is, one, kind of goes together, but one, the people that we have here, and also the capacity that we have to have the growth, like Rob said. I think we just have a very knowledgeable group that's eager to grow this business, and I'm really excited for what Ryan and his team can do, what our team can do, what the entire company can do in the coming years with the group that we have. It's a really fun group that is a work hard, play hard environment. So I think we can. There's a lot of room to grow at Calvert. So looking forward to seeing what we can do.
Kind of touched on mine, but culture, I definitely think out of anything, we have the best culture. We work with some of literally the brightest people in the industry. So we have the expertise, amazing, very good, just people who want to help one another and that aren't selfish. We just hired a bunch of people. Everyone's working very cohesively. I've worked at multiple corporations where they focus on culture as well too. And ours, I can truly say, is the best in the industry. And I've worked at Coca-Cola, Heineken, Molson Coors, and by far the people that we have here and the trajectory that we're on is unlike anything I've ever experienced. So if any listeners are curious and want to join, I'm sure there's opportunities in the future, but just such a bright future with everyone that we have.
Yeah, it's great to hear.
Jesse?
I think you guys are bang on. We have the capacity, we have the team, we have the culture. We continue to evolve our products and service in support of our clients, both current and new, which equals sustained growth. And
we got the
being in charge of growth, fires me right up.
Yeah.
We have amazing relationships with our shareholders, with our banks, with our borrowers, with our brokers. And then it's just incumbent on us to continue to make sure that we're providing the best product and solution and service so that we can just keep that flywheel rolling.
Incredible.
All right. End of the podcast.
That wraps up another episode of the Real Estate and Wealth Podcast. Be sure to hit that like button, share with fellow real estate enthusiasts, and subscribe to stay in the loop on all upcoming episodes. Get in touch with the team at Calvert Home Mortgage Investment Corporation by calling them at 1-888-752-4642 or email admin@chmic.ca. The opinions expressed in each episode belong to the individuals featured and do not represent the views of Calvert Home Mortgage. While we provide valuable insights, consulting with qualified professionals ensures that your unique financial circumstances are carefully considered, aligning your investments with your long-term objectives. Calvert Home Mortgage Investment Corporation is not a financial advisor, and we cannot advise you on making investments. There are risks to investing in real estate and the potential that you can lose all of your investment.